Welcome to the Three Edge Week in Review for the week of March 27th. I'm Fritz, Folts, the Chief Investment Strategist here at Three Edge. Joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. This week, Steve and I will discuss reasons why, at times, even risk-free U.S. Treasuries may not always be a safe investment. But before we get to today's topic, take a quick look at what transpired in the past week in the global capital markets, where on Friday we marked the end of the first quarter of 2023. And U.S. equities turned in their second consecutive quarter of positive returns, led by a strong rebound in technology stocks, which had their best quarter since the middle of 2020. Also in the first quarter, both European equities and gold outperformed the S&P 500 index. The yield curve, however, the difference between short and long-term interest rates, remains inverted, meaning short-term yields are higher than long-term yields, and as we know, an inverted yield curve may signal that it does signal that investors are concerned about the strength of the economy and fear of a possible recession on the horizon, which could prompt the Fed to cut interest rates. Also, another interesting development, money market mutual funds are attracting cash at a very rapid pace as people take their funds out of bank deposit accounts in search of higher yields. And a recent report indicated that approximately $5 trillion worth of bank deposits have now exited the banks for money market mutual funds. And this development could, at some point, pose a risk, not only for banks, but also for the economy. And then lastly, yesterday, the Bureau of Economic Analysis released its report on the Core Personal Consumption Expenditures Price Index, which is a mouthful, otherwise known as the Core PCE for February. And this is the report that's very closely watched by investors since it's the Federal Reserve's preferred measure of inflation. And what we saw was core PCE rise by 0.3% for the month, a slight downturn from the prior month. And year over year, the core PCE rose by 4.6% compared to January's 4.7%. So while the report did show a slight decline in inflation remains stubbornly well above the Fed's target of 2%. So let's get to today's topic, and let me bring Steve in here. And Steve, why don't maybe there's been a lot of talk, particularly around Silicon Valley Bank, right? Which was this bank that, they invested in Treasuries, and Treasuries are supposed to be safe, and that didn't turn out so well. So maybe if you could just explain how in some instances even U.S. Treasuries are not safe investments in order to level set. That would be great.
Well, Fritz, I think that's an important question because it's not always so easily well understood. Mm. There are two primary ways that investors can lose money in bonds. One is, again, when you buy a bond, it's the same thing as lending somebody or a company or an organization money. One way to lose money is you lend that money or you buy that bond and the company goes bankrupt or they have such a difficult time they can't pay you back. So that's one way you can lose money. And that was very much what was going on with the financial crisis of 2008. There were a lot of bonds that people bought, and those bonds were of very low quality and couldn't be paid back. And that caused all kinds of problems, and we had the Great Recession. Lately, with the banking system problems that we've had much more recently, like you mentioned Silicon Valley Bank and a few others, it's the other way that you can lose money in bonds. You can have the safest credits, meaning the organizations that are least likely not to pay you back, which is the U.S. government. But the second way you can lose money in bonds is if you buy a long-term bond at a certain interest rate. And then interest rates, after you bought that bond and locked in those rates, interest rates went up quite a bit. Because when you buy a bond, you get a fixed set of dividend or income interest payments. Mm-hmm. Someone else, now that interest rates are higher, are going to pay less for that bond than you paid because they get the same fixed stream of interest payments, but to match the prevailing interest rate, they have to pay less money for that bond. Otherwise, they're going to get a bad deal. They're not going to get what the prevailing rate is. Yep. So in effect, what you pay for that bond is no longer the market price. The market price is now much lower because someone's going to pay less for that same bond. So what happened more recently is that the lesson that everyone learned when the financial crisis was, don't buy low quality credits where they might not be able to pay you back. Buy treasuries. So that solved half the problem. Well, the other half of the problem was so many banks, and Silicon Valley Bank is a great example, but there are many others, who took their depositors' money and used it to buy U.S. Treasury bonds or U.S. mortgage-backed securities at very, very low interest rates, some of the lowest interest rates we've seen in centuries. And then when interest rates went up a lot, they're sitting on massive paper losses on their bond portfolio. So those bonds are not worth nearly as much. And it happened to a lot of investors in 2022. There's this notion that if you buy bonds, that's a safe part of your portfolio. Well, a lot of people bought what they thought were safe bonds. But in 2022, when interest rates went up, the bond indices had some of their worst performance in decades.
I like the last point that you brought up. Very interesting. So let's follow on that thread and talk about what happened with the 60-40 portfolio last year. How, obviously the bonds didn't help you. So if we look at this in longer term, in looking back on history, so therefore are going to be periods of time where that 60-40 portfolio is going to work for you, and then there are going to be periods of time when it's not going to work. So maybe you could just look back in history and tell us when it did happen to work, when it didn't, and why.
So for the last 4 decades until 2020, 60-40 bond portfolio, 60% equities, 40% bonds, was a nice way to manage money because the bonds acted as a hedge for equities. When equities did well, you made money on your 60% of your equities. When equities did badly, well, bonds made you money. And so it was a nice balancing act. The reason why bonds did so well over the last 4 decades, and we're going to show a chart here, is that bonds had the greatest bull market in history from 1980 to 2020. And you can see that on the chart. Mm-hmm. Over and above inflation, you made a lot of money by being in the bond market. And so that acted as a nice complement in your portfolio. And the reason why is inflation and interest rates peaked in the very early 1980s. And although they don't always come down in a straight line, there are always blips and cycles and so on. Generally, interest rates and inflation came from double digits, middle double digits, all the way down to 2020, where they were close to zero. And so, as we described before, when you lock in those high rates, when you buy those long-term bonds, you lock in the high rates, and now interest rates come down, people are willing to pay more for that bond than you paid, right, because they're getting that fixed income stream. And so you're not only getting your interest from the bond, but your principal is appreciating, just the opposite of what happened recently at, say, Silicon Valley Bank. So that was a great portfolio strategy from 1980 to 2020. But in 2020, interest rates hit almost zero. And from that point on, interest rates have been rising. It's been a terrible strategy, but so many people who practice money management, or so many investors who are used to a certain way of investing that has worked so well for so long, it's hard to adapt or change. You think, well, this is temporary. It's all going to go back to normal. But we think it's been a regime shift. Now, let's look at the next chart, and it shows a very different period from 1940 to 1980. And in 1940, similar to what we had in 2020, we had very low interest rates, very low inflation. And all of a sudden, interest rates and inflation started to go up for the next 40 years. And during that period, it was a terrible time to be a long-term bond investor. And as you can see from this chart, it was the worst bear market in bonds, where you actually lost wealth compared to inflation. If you were a bond investor, you would have lost more than half of your wealth relative to inflation over that 40-year period. And frankly, we believe that this period, a period just like this, started in 2020. And we talked about it in our videos going back 2 years. And sure enough, what we see is that the experience from 2020 to now in the bond market has been tracking even a bit worse than that 1940 to 1980 experience. So we think that investors should be adapting and adjusting and evolving, realizing that we're not in that bull market anymore. We can't see interest rates fall another 15% because they hit zero. They can go up and down and in cycles, and we always see volatility, but generally speaking, they're bound to go back up again. So we don't think long-term bonds are as safe as people realize, because they were so used to 40 years of the best experience in the bond market that history has ever seen.
Excellent. Okay. So now, as always, my final question is based on what you've discussed here today about the risks of investing in even supposedly risk-free U.S. Treasuries. How should investors think about positioning their portfolios at this point?
So right now, recently, there's been a temptation to go back into the long-term bond market. People thought, well, maybe we saw the worst. Some of the hedge funds who had been short the bond market, betting on yields going up and bond prices going down, had to cover their bets, and that added pressure on yields coming back down. Other people think, well, we're going to have a recession. Every time in the last 4 decades we've had a recession, bond yields have come down, so it's going to happen again. So bond yields have started to come down a bit, but we would caution that this would be perhaps a temporary condition in what would be a longer-term rise in bond yields. We think that it's going to be harder for the government that keeps getting more and more in debt to issue bonds and have people on the other side willing to buy them. Bond yields are still below the rate of inflation. So if you buy a bond now, you're not even keeping up with the rate of inflation. And there's no guarantee that inflation is going to come down to 2% as quickly as some people think. It might prove to be more sticky, and it seems to be so far. So we would advocate migrating away from that 60-40 that worked so well from 1980 to 2020, realizing we're in a different regime now where we've seen the best the bonds can offer, and be modest with your allocation of longer-term bonds. Focus more on shorter-term treasuries. And in fact, you can buy a short-term treasury ETF like we do, or fund, and you actually get a higher yield between 1 month and 1 year, and specifically around the 6-month time, than you do with the bonds, and you have no duration risk. So on that part of the portfolio, we're still advocating keeping the credit quality strong, which are U.S. governments and treasuries, keeping the duration short to not have that duration risk. And then with the rest of the portfolio, we have seen, as what we called in an earlier video, an echo bubble, where after the big downturn in 2022, markets have actually done reasonably well this year. However, if you look closely, most stocks haven't gone up this year. It's been a narrow few technology stocks that have dragged those indices higher. And usually that's more akin to what happens near the end of a peak rather than the beginning of a bull market. So we're still cautious with equities. We noticed that some non-U.S. equities, like in Europe, are outperforming U.S. equities in a much better valuation. So we still have been favoring some of the non-U.S. equities like European equities. We still like short-term tips, and they've been outperforming even the short-term treasuries so far this year. But otherwise, we're leery that as the economy unfolds during the year, as you mentioned, the banking system is forced to tighten because they made some bad mistakes buying all these long-term bonds. Now they're going to have to worry about their own credit quality. This could cause a global slowdown in the economy, squeeze corporate profits, and there's still the prospect of the next leg of the bear market in our future.
Excellent. Great. Very good. Well, thank you very much for your insight. Very important topic, and very interesting, all the alternative ways to think about investing in this environment. So very, very helpful. So that will do it for Steve and me for this week. As a reminder, our videos are always available on our 3Edge YouTube channel. You can just go to YouTube, type in 3Edge, and you'll see the whole listing of the videos that we make on a weekly basis. And all our videos and written commentaries also available on our website. And our website is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.